Tony, we won't talk about supply and auctions just yet. Let's focus on this soft, hard landing debate. Where are you and the team on that? And how would a $140 crude price influence your thinking?
Well, it does seem like the odds of a soft landing are reasonably good, but it's tough to manage. What the Federal Reserve wants, of course, is to avoid an outright recession. Recession defined as a decrease in employment and output. What it wants is a growth recession, which is that soft spot, the soft landing between 0% growth and 1.8, which is the growth potential. Navigating it into that narrow runway is challenging. The price of oil rising, of course, will reduce aggregate demand, perhaps, and that will likely help bring it into that zone. But lots of other things have to happen. Lots of things can be broken along the way. For example, we see the Federal Reserve affecting the housing market through higher interest rates, et cetera, very difficult to manage. But the final word I would say is it does look like the chances of a soft landing are pretty good. The chances of a deep recession are pretty low.
Anthony, I want to talk of all your expertise across the globe on short-term paper. The anomaly is Japan. Can they ignore the Fed, the ECB, the Bank of England, and everybody else, including RBA, as John mentioned earlier? I mean, it's out there that that Japan wants to play by a different playbook. Can they get away with that?
The real challenge is when the Governor Kuroda, who leads the Bank of Japan, leaves next April. There will be a communications challenge, and communications are awfully important to central banks these days, sometimes more important than the actions they take. And they'll have to navigate that period, which could be tumultuous. And so it's possible that Japan will have difficulties in the same way that some nations have difficulties defending the currency pegs. So if interest rates are high globally, it might get challenging. What will help Japan, of course, is the very challenging demographics, with the population continuing to shrink at 125 million today, looking like it's going to go to under 100 million by the year 2050. So that's a force that will keep wage pressures down, it's expected. And the cohesiveness of the society enables it to achieve certain goals. But again, the communications challenge surrounding the passing of the baton to the next governor is going to be pretty high.
Tony, when we talk about a softer hard landing in the United States, we're also talking about the measurement of inflation, as Larry Summers pointed out, former Treasury Secretary, in a study that came out yesterday, saying that basically on an adjusted basis, inflation right now is highly comparable to the peak that we saw in 1980. Do you think that that creates a real problem, given what the Fed has to do in order to bring inflation back down to their target, or do you just reject it?
Well, the Federal Reserve is succeeding in many ways in keeping inflation expectations from moving upward, and it appears as if it's helping inflation expectations to move downward. We can see this in the Federal Reserve's favorite gauge of inflation expectations, the so-called five-year. The five-year is a way of leaping past the noise from the rise in the price of oil, the rise in food prices, the rise in lots of things that are occurring in the short run, partly because of cyclical reasons, partly because of the pandemic, and also the war in Ukraine. It's a way of looking at where inflation expectations, looking 5 years out, will be 5 years forward from that, which is a 10-year horizon. And that figure's come down from a 250 to about a 220. And finally, Lisa, looking at the term premium, the amount of yield that an investor gets for moving out along the yield curve, it's still negative, and historically it's been positive. In other words, you could simply glance at the yield curve if you don't want to gauge this mathematically, and see you're not getting much to move out on the yield curve, and that means there's not much term premium. There would be a larger term premium if inflation were a bigger worry. So this is a long way of saying that market participants still view the Federal Reserve as credible and will succeed ultimately in achieving its inflation goal of 2.6% for the end of, not a goal, but that's its expectation, 2.6% for the end of 2023. The question is how it gets there. Does it require a lot of tightening, or do we get the elusive soft landing?